Hey everyone, welcome back to Noobs Selling Options. It is absolutely fantastic to have you hanging out with us again. Today, we are diving into a completely mind-bending reality about the global economy, and honestly, it challenges everything you probably thought you knew about cash. In this explainer, we're going to unpack the wild paradox of global debt, explore the hidden mechanics of leverage, and then we're going to connect all these massive global concepts right back to your very own trading portfolio. Trust me, by the end of this, you are going to look at your brokerage account in a completely different light. All right, let's jump right in. Depending on exactly how you measure it, the total estimated global debt for 2025 sits somewhere between a staggering $315 and $340 trillion. Meanwhile, the entire global money supply, the M2, which is all your physical cash plus accessible checking and savings accounts, is only about 120 to 180 trillion. Do you see the math there? Global debt is literally 2 to 3 times larger than the physical and accessible money supply on Earth. We owe more money than actually exists. So the immediate glaring question is, how on earth does a financial system survive when there's way more debt than actual money to pay it off? It just seems completely backwards, right? Section 1. A brief history of money. Let's see where all this debt actually comes from.
You know, what's really fascinating is that this isn't some modern glitch in the matrix. Having more debt than money has actually been the norm for centuries. It's a fundamental, baked-in design feature of modern banking. We can trace this whole thing back to the European goldsmiths in the 15th through 17th centuries, straight through to the birth of the Bank of England in 1694, all the way up to the massive shift in 1971 known as the Nixon Shock.
Picture this, you're back in the Renaissance with the early goldsmiths. People would store their heavy, physical gold with them for safekeeping, and they'd get a paper receipt in return. Eventually, everyone realized it was just way easier to trade the paper receipts than lugging actual gold everywhere. But here was the absolute light bulb moment. The goldsmiths figured out that not everyone comes back to claim their gold at the exact same time, so they started issuing way more paper receipts, which were basically promises or debt, than the actual gold they had sitting in the vault. And boom, just like that, fractional reserve banking was born. From that precise moment on, the promises to pay officially outnumbered the actual money available. All right, let's fast forward to 1971. Up until this point, the US dollar was still theoretically tied to gold, but President Nixon ended that convertibility, pulling the world entirely off the gold standard. Enter the era of fiat currency. Now money holds value simply because the government says it does, and because we all collectively agree to trust it. Without the physical anchor of gold, central and commercial banks could create crivet, meaning debt, so much more freely. That is exactly when global debt levels went entirely parabolic and skyrocketed to those massive multiples we talked about earlier. Now wrap your head around this. Most money today is literally created out of debt. The reason debt will mathematically always be larger than the physical money supply is right here. When you go get a mortgage, the banker doesn't walk down to a dusty vault, grab a duffel bag of cash, and hand it over. No way. They just type some numbers into a computer. In that exact millisecond, new digital money hits the seller's account, and new debt gets slapped under your name. Banks create new digital money every single time they issue a loan, so the total amount of debt is always going to massively outpace the actual physical currency printed by central banks. Section 2. How the math works. Let's look at how this whole machine keeps turning without flying apart. It all boils down to a concept called the velocity of money. Remember, debt is just a promise to pay someone in the future. The physical money doesn't actually need to exist today to promise it tomorrow. Imagine you have a single $10 bill. Step 1, you use that $10 to pay off a debt you owe your buddy. Step 2, your buddy takes that exact same $10 bill and immediately hands it to his mechanic for an oil change. Look at what just happened. That one physical piece of paper just paid off $20 worth of debt. Because money circulates so fast, a tiny money supply can easily service a gigantic mountain of debt over time. Add to that the modern cycle of credit creation we see with fractional reserve banking. You deposit $1,000 into your checking account, right? Well, your bank definitely doesn't lock it away. They hold a tiny fraction on reserve and lend the rest out to someone else. That new loan instantly creates new debt. The borrower spends it, it ends up in a different bank, and that bank lends it out again. This cycle repeats over and over, essentially spinning up debt vastly faster than a central bank could ever dream of printing physical cash. Which leads us to the obvious question, is this whole thing just a massive ticking time bomb? Well, not necessarily. The entire global economy runs on credit. Businesses need it to build infrastructure, families need it to buy homes. As long as the economy keeps growing, incomes go up, and money keeps changing hands rapidly, that debt is totally manageable. But it is an incredibly sensitive balancing act. If the economy stalls out or if interest rates spike and make it super expensive to pay back those promises, that massive mountain of debt suddenly becomes a very real, very dangerous liability. All right, Section 3, leverage in your portfolio. Let's pivot from the macroeconomy directly to your trading screens. Leverage is simply using borrowed capital to supercharge your potential returns. Just like the global economy uses credit to expand faster than physical cash allows, you can use leverage to control a much larger position than your actual cash on hand would permit. For us, there are 3 really common ways to do this: margin trading, options trading, and real estate. Let's break these down. Think about real estate. It's honestly the most socially accepted form of leverage there is. You put down 20%, and the bank essentially fronts you the other 80%. If that property appreciates by 5%, you aren't just making 5% on your down payment, you're making 5% on the entire value of the asset. Margin trading is basically the exact same concept, just way more direct. You borrow cash directly from your brokerage. With a standard 2-to-1 margin, your 10 grand in cash can buy 20 grand worth of mega cap tech stocks. The stock goes up 10%, your $20,000 position makes 2 grand. That is a 20% return on your actual cash. It's a wildly powerful tool to hit those high-yield growth targets. And for the options traders tuning in, we have to talk about LEAPs, long-term equity anticipation securities. Now, options aren't a traditional bank loan, obviously, but they are inherently leveraged. Buying a LEAPs call option that expires in a year or two gives you the price action of 100 shares of a company, but the premium you pay is a tiny fraction of what those shares would cost outright. The market is essentially spotting you the capital difference required to control that asset. You capture all the upside exposure without tying up all your cash. Which transitions us perfectly into an absolute favorite strategy here at Noob Selling Options, the wheel strategy. Advanced traders who use the wheel to generate premium income usually optimize it by tapping into their portfolio's margin buying power, rather than just letting massive amounts of strict cash sit idle to back their trades. By utilizing the brokerage's credit, they can collect premiums on a much, much larger scale, totally accelerating their income generation. Section 4. The double-edged sword. Now, hold on, because we need to completely shift the tone here for a second and talk about the dangers. This is the absolute, non-negotiable reality of leverage. It is perfectly symmetrical. Yes, on the upside, it mathematically accelerates your compounding. It's an incredible tool. But man, on the downside, it amplifies your losses by that exact same multiple. Plus, remember, you are paying interest on that borrowed margin. If an asset drops hard, not only are your losses multiplied, but you trigger the dreaded margin call. That's where your broker steps in and forcefully liquidates your assets at a huge loss just to cover the debt you owe them. And this is literally life or death for your account depending on what you trade. If you're operating in highly volatile markets like tech or the complete wild west of crypto, unmanaged leverage is basically playing catch with dynamite. Massive overnight swings can gap right past your stop losses, triggering forced liquidations that will wipe your entire account out in the blink of an eye. Strict risk management here isn't just a good idea, it is an absolute requirement for survival. Hey, really quick, if you are enjoying this deep dive into the real mechanics of the system and learning how to navigate these complex trading strategies, do me a huge favor. Smash that like button and hit subscribe for news at Selling Options. It really helps the channel out, and it guarantees you won't miss out on the deep dive explainers that actually move the needle in your portfolio. All right, wrapping things up, I want to leave you with this final thought. We've seen how a mountain of global debt, built on centuries of fractional banking, literally fuels the modern world. But when it comes to your own money, you really have to look in the mirror and ask, is the leverage you're using in your portfolio a calculated tool mathematically building your wealth, or is it an unmanaged threat just waiting to wipe you out? Take a hard look at your positions today, respect the incredible power of debt, and trade smart. I'll see you all in the next explainer.